William Lee is joining us. He's the chief economist at the Milken Institute. Bill, thanks for joining for an emergency hit here. Let's talk about what happened and then what might happen tomorrow. Bill, how come people keep dumping Treasury bonds if Jay Powell keeps promising to never hike?
Well, the Fed controls the short end, as you know, but the long end is up to the markets. And markets do what they do best. They overreact. Right now, the markets have overreacted in lowering rates. The bull market for several decades now have lowered 10-year rates to the lowest levels ever. And now, as we're in a recovery, they should be going up. In fact, if you remember where the long-term 10-year rate was right at the start of COVID, it was at 1.9. And that was when we were facing GDP growth somewhere in the 1.5% to 2.5% range. And so now we face a recovery where we're expecting next quarter or the current quarter GDP to be about 9 or 10% and the yearly GDP to be somewhere in 6%. It's ridiculous that long-term rates are as low as they are. So they should be going up. Now also, equity markets do what they do well, which is also overreact. When you have a huge recovery coming on and likely to be sustained for several years, what's the one thing you can clearly expect? Profits. And yet, markets go down because they say, oh my God, I'm discounting with a higher interest rate. So these to me are the signs that markets are in a tizzy about overreactions and not knowing where the economy is going. And the one thing Chair Powell has tried to reassure us about is the economy is doing very well. It's improving. It's going to grow very quickly. We're going to get some bottleneck pressures on prices. But once those are alleviated, we're going to come back to moderate inflations and we're going to have trouble sustaining 2%. That's the world we face.
Bill, to your point about how that short end and the rates are a very separate story from the, let's just call it speculation that's happening on the long end, right? Just like speculation in stocks. What's interesting here is as we are getting more information about that recovery and we're having then to reprice yields and similarly repricing what we pay for cash flows and earnings in companies, then should we believe this relationship to accelerate as it becomes clear the economy gets better? If we actually start seeing some of the gaps close in things like employment, would that mean that what we're seeing right now actually accelerates?
The time path for recovery is one that's highly uncertain because it's not clear how well the vaccines are going to do. It's not clear how quickly people are going to resume normal life again. And it's not clear how much price pressure there's going to be on the initial onslaught when everyone starts booking their travel tickets, everyone starts booking their hotel tickets and restaurant reservations. So the service sector is really key to what future inflation is going to look like. And it looks to me like the service sector has a lot of potential deflationary forces. The first thing to keep in mind is the companies have reorganized to become more efficient. They've incorporated new technologies so that they also become more efficient. So there are a lot of downward pressures in the service sector to begin with. And remember, where was the inflation coming from in the service sector? Rents, healthcare, right? Rents are certainly on a downward spiral in the major cities, and healthcare costs, because of teledoc and all of these other innovations, have also become much more moderated. So to me, the sources of traditional inflation in the service sector just aren't there to get the Fed to be worried. Initial price level pressures, initial opening pressures, they're absolutely there. So in terms of the link between the long and short-term yield, the likelihood is we're going to get a steepening of the yield curve because the long end should be going up to somewhere in that 2 to 2.25% range, which is normal for a 2 to 3% recovery in the year 2023. Between now and 2023, that surge in demand is going to be met with bottlenecks, but I think the supply curve is going to be pretty elastic because there are a lot of people unemployed. There are a lot of people who are been laid off from their jobs who are ready to come back on.
Bill, I just want to go back to because you gave us some numbers there about growth and what we might expect for bonds. You said in a growth environment, 2% yields. How are you thinking right now about maybe what would be a reasonable price for that 10-year given the growth prospects, which could surge, some estimates say as high as 10% next quarter on a year-over-year basis, but would probably obviously fizzle down to something more reasonable going forward. What do you think makes sense right now based on the economic prospects you see?
That initial surge that we're going to experience will be the big push for 10-year rates to go up, and also a push for the belly of the curve to go up as well. So the key is that the Fed is going to be there locking down that short end, and the belly might be rising as well as the long end will be rising. So certainly anyone who's got a steepener out there has got the right trade. The likelihood of we're getting 2 to 3% inflation in 2023-24 is very, very low, because the long-term growth of this economy is barely 2%. Even with the technological changes that have been put in place, I don't think we're going to be exceeding 2% on a continuing basis. So the likelihood is in 2024, the long-term rate will be somewhere in that 2.25 range when the expected inflation, the 10-year, the 5-year, or the 10-year break-evens are going to be hugging that 2% curve. So the real interest rate, in some sense, should be no more than 1/4 to 1/2 percentage point.
One of the things I see that might be an issue, Bill, in terms of thinking about where the yield goes, is if we don't know when Powell is going to hike, which he's said he's not going to until some sustained period. So we don't know when he's going to hike. Whereas in the past, we might say, okay, once we get to 2%, then the odds of a hike go up. So therefore, we know there's this counteracting force. So while it might sound paradoxical, the issue that I've had with this policy is that, well, if we don't know when the counteracting force is, then it's possible we may not really have one. So then if the trajectory is just going to keep going up and up, why would yields stop until we know where the counteracting force is? Why would we not just see this bond market run until Powell goes, okay, enough, it's not going to get that out of control?
There's a natural sort of countervailing forces that are in play. Right now, there's a ton of savings out there, so anybody who wants to finance a project can get the funding. That savings is going to get dwindled away, especially as people start to consume more. So that natural tightening of pressure in the capital markets for the cost of funds is going to be the force that raises rates at the rate that's appropriate for the rate of growth. So in that sense, the Fed really doesn't have to do much, because the markets themselves will be allocating the capital once it becomes scarce. Right now, there's no scarce capital, which is why people are surprised that these rates are jumping so much, which also tells you they're way below where the equilibrium rate should be. So I think the question of how fast is determined by how much savings is available and how quickly people use up that savings in their consumption. Now,
if they use up that savings, so what we need to be looking for is real activity, right? People buying airline tickets, buying cruises, buying clothes, peacocking, according to the Gap CEO, who just said that people are going to buy clothes to look sharp. Those are things we're looking for to really determine kind of how hot this thing gets in the short term.
The other thing I'd be looking for is the cost of equity capital. If the stock market prices continue to come back to their higher levels that they were just a month ago, that's a very easy set of financial conditions for companies to finance their investment projects with equity. So it's not always credit markets that tell you the true cost of capital. But one of the things that I'm concerned with is that this overreaction in the equity market is increasing the cost.
Right, could tighten things, right?
Exactly. And that kind of tightening is what Chair Powell warned about. He said if markets become disorderly,
right,
they're going to step in and do something about it.
Where do you think his threshold is? Well, Bill, sorry to jump in because we're almost out of time. I mean, where is it? Do we know? 10%, 20% bear market? Are we just never going to have a bear market because it's too tight? Come on.
We Twittered about this, and I'm telling you, the equity market volatility is less of an indicator for the Fed because it's less systemic. The real systemic issue is where's that volatility in the bond market? And if you go back to 2018, when they were raising rates, the bond market volatility was fairly low, but when they lowered rates, that bond market move volatility was well up into the 70s.
Okay, so we've got a buffer zone in that credit market before they start to get worried, right?
Absolutely.
Okay, that doesn't sound like the most reassuring message on stocks, Bill.
You and me both, because I think the irrationality in that crash in the tech sector is ridiculous, because it's the tech sector that's going to give you the productivity gains in the service sector to keep that inflation down. That's positive dynamic is something that has to be in play, and that's what the Fed is also counting on.
Okay, thanks, Will. Appreciate it. William Lee joining us, the chief economist at the Milken Institute. Some really good economic talk today, starting with a little trading talk and ending with some academics here. Bill joins us from the Milken Institute.